podcast with me, your host, Krystal, also known by my artist name of the most famous woman in the world. So today I want to talk about something that I think most of us don't really realize, which is two things. One, there's a difference between trading and investing. And number two, that investing for the vast majority of people should be and is, but especially should be extremely easy. So let me get to the first thing that I wanted to talk about, which is the difference between investing and trading. So investing is when you are seeking larger returns over an extended period of time, usually through buying an asset such as a stock and holding it for many years. So that would mean something like you bought a S&P 500 low-cost index fund stock, and you're holding it for 25 years. Okay, that's investing. Another example of investing would be to buy a rental property and keep that for 15 years. So these are longer-term decisions, and of course, by the very nature of it being longer-term, typically longer-term investments do better because of something called dollar cost averaging. And for those of you who don't know what dollar cost averaging is, investors use this very simple method in order to avoid having to time the market. Traders, on the other hand, are people who, so for example, you probably have heard of day traders or people who buy and sell stocks and other assets such as bonds or potentially trading foreign currencies, also known as Forex. So those are people who buy and sell short term. And those people are looking to take advantage of the ups and downs of the market. And pretty much any and all reliable financial gurus out there, and I don't mean YouTubers, I mean people like Warren Buffett, who is largely considered to be the best investor in the world, the best and brightest minds ever in investing, do not recommend that the vast majority of people, they do not recommend that you trade. So I have a couple of friends, and I'm not going to name names but I have a couple of friends who believe they are traders, but they don't have they really don't have the background to actually be successful in that over a very long period of time. And you can look up multiple studies done on asset managers, so like hedge fund managers, professional portfolio managers versus the S&P 500. And the S&P 500 nearly always, it might be even always, but I definitely know nearly always comes out with higher rates of returns than a human being trying to manage that and trying to beat the market. It's typically called trying to beat the market. So people who believe that they somehow are going to make you higher returns over the long term than the top 500 United States companies on average, which when you look at it like that, it seems absurd, and it is. And that's why people like Warren Buffett recommend that you keep your investing extremely simple. And this goes against a lot of other people's advice, but I kind of look at it like, well, if you're going to do something, you might as well listen to the best in the world, who has the track record to prove what they're talking about. And just to keep it very simple, we can just look at one of them, name Warren Buffett. And so with that, like I said before, most extremely responsible investing advisors or people who give advice will tell you just simply take a certain amount of money each month away from your, from your budget, from your income, and just put the same exact amount every month into a low cost index fund. And it doesn't have to be complicated. And the less complicated, actually, the better. So you don't and shouldn't be going on apps like Robinhood and Webull and whatever else and trying to pick individual companies thinking that you're going to somehow beat the overall stock market. So that would mean, doing things like, which, full disclosure, I did participate in the GameStop phenomena, the craziness that happened with that, but I didn't invest and I didn't play with a lot of money. I was really doing it just for fun, and I made a few $100. So I wasn't sitting there, investing millions of dollars or something, or even thousands or hundreds of thousands of dollars into that. It was just a few bucks that I thought it would be fun to kind of just ride the wave and see what happens and kind of get on board with the people because it was fun, not because I was looking at that as a real actual investment. So you can look at investing as literally just buying one S&P 500 index fund. And let's say putting $300 a month toward that on automatic, and just set it and forget it. And that's it. Simple. I think a lot of people avoid doing this because it's so simple, because we think, well, it couldn't possibly be that simple. There has to be something else. I have to know about mutual funds and ETFs and 401ks and Roth IRAs and gold and silver and individual stocks. And what about call options? And what about everything else and crypto? And how much percentage should I put? Okay, yes, definitely you can do that. Of course, you can do whatever you want. It's a free country. But by and large, worrying about all of that is not going to give you a higher return on investment than simply dollar cost averaging into the S&P 500. And if you can look up all kinds of graphs of the performance of the S&P 500 over many, many decades, and you can compare that to other vehicles, and you can just simply see for yourself what happens. Warren Buffett actually gives the advice of putting 90% of your income into a low-cost S&P 500 index fund. And not to get too into the weeds, but yes, different companies offer it's the same idea, right? But there's different companies that have different fees. So when someone says a low-cost index fund, what they're trying to say is just you should try to look for a company that charges the least fees to use their service. And they don't vary wildly in fees, but adding up cents over decades and decades will add up. So that's why that is recommended. Also, some of the funds actually have a minimum. So like some of the companies offer, better fees, let's say, but there's sometimes like a $15,000 minimum or something like that. But don't be scared by that, because there's definitely plenty of companies that you can invest as little as $1. So don't worry about that. But yeah, if you want to start, you can start today. Just look up low cost S&P 500 index fund, and then put as much as you can, as much as you're comfortable with, same amount every month. Just pretend like that's just, you don't have that money. It's not a savings account. It's not a checking account. You're not supposed to pull it out. You're not supposed to look at it. You're not supposed to check it every single day and look and see how much it's going up. Like that's not the idea with it, and that's not the purpose of it. But yeah, actually, I wanted to also just give you a couple of Warren Buffett quotes about this because it's actually pretty funny. So there's a headline a couple years ago at the 2022 Berkshire Hathaway annual shareholders meeting, which Berkshire Hathaway is Warren Buffett's company of companies, so company that owns companies. And that's also a fund that you can invest in as well. But so he says that monkeys could do as good of a job investing as Wall Street financial advisors. Monkeys could do as good of a job investing as Wall Street financial advisors. Yes. So, and he's saying this it's true. So he's just basically saying what I just said about that the vast majority of portfolio managers can't beat the S&P 500. And just to peel back the onion and a little bit so you can think about the S&P 500 in a more realistic way, just look at it like the top 500 companies in America. They're companies, they're businesses. So it's, when we think about the S&P 500, it can be very abstract and almost like disconnected from reality. But when you think, no, it's just the cumulative output, the cumulative profits and output of the top 500 companies. When you look at it like that, it makes sense. It makes complete sense of how hard it would be to outperform that as one human being trying to pick individual companies. So when we think of stocks, just please remember those are actually companies, right? So a portfolio manager is someone who is trying to pick individual stocks and pick individual funds and add them up in a way that will give you the highest rate of returns. And I'm not saying that it's completely impossible, but it's almost impossible. Almost impossible over a long enough period. And by a long enough period, I mean, let's say over a few decades, over the course of time, it would take for someone to dollar cost average their into saving enough for their retirement. So basically the point of this is to say, keep it simple, stupid. It doesn't have to be super complicated. You don't have to go take a whole financial course in order to start investing wisely. You can just look to the best in the world, and he literally tells us just keep it extremely simple. Of course, there's many other strategies, and yes, you should. Well, I shouldn't say you should, but yes, you can obviously diversify beyond that. And there's people who also very reputable people who I take some advice from as well, like Robert Kiyosaki from Rich Dad Poor Dad. So he recommends going out and basically doing yourself what banks do. But to be honest, a lot of us, when we're first starting out, or even when we're not first starting out, but when we're just doing our life, a lot of us realistically don't have the time and energy to do that. So one way that you can dip your toe in and definitely be at least on the right foundation and on the right path without having to do really almost any research at all. I mean, the research you would have to do could take maybe 15 minutes. Googling S&P 500 low cost index fund and then connecting your account to whichever platform you want, and you're done, and that's it. And then set up automatic. Like, that's it. You can start there, and a lot of people don't even just start there. They start and end there, and they might put maybe 10% of their income in something else. So I hope this helps us. And until next time, remember, each one teach one.
The information provided in this podcast is for educational and entertainment purposes only and should not be construed as financial advice, investment advice, or medical advice. The host is not a financial advisor nor a medical doctor or licensed therapist. Any financial or medical decisions made based on the information in this podcast are made at the listener's own risk. It is recommended that listeners consult with licensed professionals such as CPAs, financial advisors, and licensed physicians before making any investment or medical decisions. The host and creators of this podcast accept no responsibility or liability for any loss or damages incurred as a result of the information provided in this podcast.